Good afternoon and welcome to our webinar on employee ownership trusts. My name is Matt Wilmot. I'm a partner in the corporate finance team here at PKF Francis Clark. I specialise in company sales, acquisitions, management buyouts, and today's subject, employee ownership trusts. I'm going to be the host of today's panel discussion, ably supported by a range of experts from across the firm who will introduce themselves in just a minute. Now, in terms of the context of today's webinar, we've seen a huge increase in the popularity of employee ownership trusts, or EOTs, over the last few years, despite them being around since 2014. Now, that interest has increased even further since the changes to capital gains tax that were made in last autumn's budget, as business owners look at the various ways in which they can realise value and exit their business. So our aim today is to try and answer some of those frequently asked questions that clients and prospects come to us and ask about employee ownership trusts. They try to assess whether it is the right sort of transaction for them or not. There's a lot to get through today, and there's a lot of questions that we've got, but please do feel free to ask questions as we go into the sort of Q&A function on the side. We'll try and pick them up as we go, but those we don't, we'll try to get to at the end if we have time. So moving swiftly on, we'll go into introductions. So Nicola, could you go first, please?
Thanks, Matt. I'm Nicola Mann-Clark. I'm a tax partner here at Francis Clark, specialising in transactions and including employee ownership trusts.
Thanks, Nicola. Doug?
Hi, everyone. Thanks for joining. My name's Doug Oatman. I'm a senior manager in the shares team at Francis Clark, and I've worked here for 8 years. I specialise in employee share schemes, EOTs, EMI plans, solving challenges around management share issues, basically anything to do with employees or directors and shares.
Thanks, Doug. And finally, Jez.
Thanks, Matt. Yeah, so Jeremy Richards, I'm a director in the corporate finance team, and my specialist subject is debt funding. I'm a banker by background, so I help the team with any debt needs.
Brilliant. Okay, let's start off with, I guess, the fundamentals, the basics. So when we're talking about a transaction that involves selling to an employee ownership trust, what does that mean? What does that entail? Doug, perhaps you could sort of kick us off, give us an overview.
Sure. So an EOT transaction is the sale of a company, but to a special type of discretionary trust for the benefit of all the employees. Implementing an EOT is about more than just the tax and legal documents, although obviously these are important. Moving to an EO model can be transformational for the business, with a shared ethos that's different from the traditional corporate model, putting employees at the heart of the business. So to outline the steps at a very high level, an EOT is a trust set up by a trading company or the parent company of a trading group for the purpose of acquiring a controlling interest in that company, so at least 51%. The trustee of the EOT is typically a company itself, a corporate trustee with its own board of directors, which holds the shares on the terms of the trust for the employees of the company. So the employees are the beneficiaries of that trust. Once the EOT is set up, it buys the shares in the company from the existing shareholders. The consideration given for the purchase will typically be cash paid up front and a loan. The upfront cash will come from initial funds that are settled into the trust by the company and any external borrowing by the trust. And then the loan will be repaid over a period of time from contributions made by the company to the trust out of future profits.
Brilliant. Thanks, Doug. So I think one of the headlines that we often hear about EOTs is the tax rate, so 0% capital gains, rightly or wrongly. I guess, Doug, just sort of following on from that, perhaps you could give a bit of an overview as to from a shareholder's perspective, what is the tax situation when they sell to an EOT?
Absolutely. So yeah, one of the most well-known features of an EOT sale is no capital gains tax, or CGT, for the sellers. This tax relief was introduced by the government in 2014 to encourage more companies to transition to employee ownership. And as many of you will know, the main CGT rate is now 24%, and the CGT rate on disposals which qualify for business asset disposal relief is now at 14% and rising again to 18% from next April. So the ability to sell a company without any CGT arising on the vendors has made EOT sales even more attractive than they were before. And there's no limit on the amount of gain that can qualify for relief. As with all tax release, there are strings attached. I'm not going to take up the entire session by explaining the nuances of each of the conditions, but just to summarize, number one, the trustees of the EOT must be UK tax resident. Number two, the sellers and persons connected with them must not have control of the EOT post-sale. 3, the EOT must acquire a controlling interest in the company, so more than 50%. Number 4, broadly speaking, the number of continuing shareholders who are directors, employees, or persons connected with them must not be more than 40% of the total number of employees of the company or group. Number 5, the company must be a trading company or the holding company of a trading group. Number 6, all employees must be entitled to be beneficiaries of the EOT, and all employees must be able to benefit equally, although some distinctions can be made based on factors such as salary and length of service. Finally, number 7, the trustees must take all reasonable steps to ensure that the consideration paid by the EOT for the shares isn't more than market value. And these conditions must be met until the end of the 4th tax year after the end of the tax year of the sale. Otherwise, relief can be revoked. One final thing I want to mention on this is that sometimes the relief is referred to as a 0 CGT rate, which isn't strictly the case. Where the conditions are met, the transfer of shares by the sellers takes place on a no gain, no loss basis. This means that the sellers are deemed to have sold their shares for an amount equal to the original base cost, hence no gain, no loss. And the base cost, which is usually low, could be nominal value if we're talking about shares acquired on incorporation of the company. That base cost is effectively rolled over into the trust. So if the EOT sells the shares later, then the taxable gain for the trust is greater because it's inherited the seller's low base cost.
Thanks, Doug. So I think it's probably fairly apparent from that whilst the headline is fairly simple, there's a lot of complexity to it and a lot of things that need to be considered to make sure that the company is going to meet those requirements, both at the start, but also for a number of years post transaction. Okay, so just looking at, if you're a business owner and you're contemplating going into an employee ownership trust, what are the characteristics of a good EOT transaction, or what is a bad EOT? What are those things that if someone sat there going, well, is it right for me? What are the things they really need to be focused on? Nicola, do you want to take that one?
Yeah, thanks, Matt. So it can be a really great alternative succession plan to a sale to a trade buyer. Like, for example, if there's no obvious trade buyer in that particular sector, or the owners are a bit nervous perhaps about selling to such a buyer and how they might change the business in the future. So it can be a really good cultural fit, both the vendors and the employees, where vendors want to sort of secure the long-term succession of the business, maintain its legacy, and maintain the ethos that they've grown with the business. It tends to suit quite steady growth businesses, particularly those which have predictable profits and cash flow certainty. So in order to pay the deferred consideration, the loan that Doug mentioned over what can be a number of years. And we also see it work quite well with service and people-based businesses. So that it tends to suit that kind of business quite well. It's really important to engage with the management team to make sure that they're on board with the idea and the process, because they'll be key to the succession of the business. So where we've seen some problems is that where the management team has not perhaps been consulted at an early enough stage, not brought in on the journey, and also where perhaps the driving force for the rationale is just the tax rate, rather than thinking about the sort of the long-term cultural fit of employee ownership. Also, I've talked about steady growth businesses. It tends to suit those rather than those with high multiples, where the affordability of the upfront valuation can be more of a challenge.
Brilliant, thanks, Nicola. So I guess quite a sort of pertinent question around a lot of this is, what value does someone sell to an EOT? And it's not as if you've got a trade buyer who comes in and says, this is how I'm valuing the business, this is what I'm willing to pay. Perhaps Nicola, if you could sort of divulge on the process that a business or business owners need to go through in order to sort of establish what transaction that the deal happens at.
Yeah, thanks, Matt. So yeah, as you say, so there's no third party purchaser here to basically establish what that value is, and it's really important to establish the value because and as Doug mentioned, one of the requirements is that the trustees don't pay more than the market value for the shares in order to qualify for the CGT relief. So evaluation will need to be carried out to determine the market value of the shares, and typically the company and the sellers will engage advisors to help with that in the first place. It's not something which can be agreed with HMRC in terms of, you can't say to them, this is what we think the value is, and then ask them to agree it. So it is important to get an expert to help with that. And as well as the sellers and the company looking to establish what the value is, we also recommend that the trustees get evaluation advice as well, particularly given this requirement that they can't pay more than market value. So that will mean the trustees usually need to either appoint advisors to check the valuation which has been carried out by the vendors, or indeed to take their own independent valuation. The requirement that the trust can't pay more than market value and must take all reasonable steps not to pay more than market value is a new requirement, and we're not quite sure yet what HMRC mean by how they will interpret all reasonable steps. So in order to be cautious, getting a separate independent valuation is often recommended.
Thanks, Nicola. I think certainly from our team's perspective, we've got a sub team that only do valuations, and a lot of which are for these sorts of transactions. And I think it's fair to say, when it comes to valuing privately owned businesses, it's certainly an art rather than a science, and therefore there is an element of judgment in this. So I think clearly it's a very key part of the process, and certainly getting that valuation that's appropriate for the shareholders, but also appropriate for the business and what it can afford going forward, and for the trustees to be comfortable at, so it's not being over-egged, I think is an absolutely critical point. Okay, so I think just now looking on to, I think it was briefly mentioned by Doug in terms of how these transactions are paid for. So once we've agreed a valuation, the EOT is going to pay X for it, but how can it afford it? How can it get the money either upfront or over time to pay for it? So, Jez, from a sort of funding perspective, do you want to give an overview of how that might work?
Yeah, thanks, Matt. And Doug touched on some of these points, but I'll sort of recap and sort of go on to typically how we have funded transactions within the EOT market historically. So generally, cash can come from one of three places. So balance sheet cash, so cash within the business, that can be made as a payment or an initial payment to shareholders. Deferred consideration, so if there is sufficient cash on the balance sheet, an agreement can be made between the seller and the management team that is staying behind to agree a remaining amount to be repaid over time using future profits. And the third thing is external debt, which is often where I'm brought in with my expertise. So yeah, between one of or a combination of those methods is how the cash can get distributed. So in sort of regards to external debt, the UK commercial finance market, in the last 15 years has just exploded. We work with well over 150 funders within our team for any given situation. So there are lots and lots of options for teams looking to get transactions funded. We typically split our lenders into three brackets. So we've got the sort of tried and tested high street banks. Many business owners or management teams will explore with their own bank, what the options are. We do see if a bank says no, people potentially can give up, which is a shame, because We've also got the second bracket, which are the big established challenger banks now, making a real sort of play in the market. And then the third bracket, where we're seeing a lot of activity and a lot of liquidity to support transactions, is within the sort of alternative and specialist lender space, particularly with specialist debt funds. So, you know, lots of options to get businesses funded from either of those sort of three pools of lenders. And I think really, you know, sort of touched on that already, that a key aspect to getting a transaction away is for you as a team, or certainly you and your advisors, to really understand that market, and to be able to, you know, get as many best fit funders as you can to have a look at what you're doing. Don't just try one, you know, because that probably lead to not a great success. So really understanding your options. So those options, what are they? So from a debt perspective, there's broadly two options that you can look to, being cash flow loans, either from banks or challenger banks or one of the debt funds we talked about, or increasingly asset-based lending, again provided by banks, but more and more we're seeing from specialist independent asset-based lenders in the market, of which there are a good few now and some really good people within those teams. So from a cash flow lending perspective, it's probably the most common way that businesses will look to get funded for EOTs or other transactions, because essentially it's a business loan repaid from future earnings. Loans are typically 2 to 5 years, and the lender typically expects to be repaid in full over that period. There are caveats to that, which I won't cover on this call, but on a case-by-case basis, there are other ways to structure term loans. But of course, with repayments being made from future cash flow, it means the lender really needs to understand sort of financial projections and really needs to know that it's got good certainty that future cash flows are going to be positive and profitability be good to be able to lend money, so they're going to be repaid. So, you know, really important when you're planning for an EOT in regards to talking to lenders. And typically, how much can be funded? You know, that's the important question as well. With cash flow lending, we typically see in the SME and mid-market space 3 times sustainable, so sort of good 3 times recurring EBITDA annually is generally how a loan would be structured. So, you know, £2 million EBITDA, potentially you could get for £4 to £6 million into a structure. As I said, you know, the lender is really keen to understand the risks within a business that can really impact its debt service obligations, as well as sort of the financial. There's also things like the general economic growth prospects, what's going on in the sector, and there are any sort of specific considerations that need to be made for the company specifically. And then sort of coming on to asset-based lending. So asset-based lending is an increasingly specialist area where we're seeing good appetite from funders who can structure deals for EOTs. Asset-based lending involves borrowing against business assets such as receivables, inventory, plant, machinery, property. Lenders typically can offer what we deem revolving credit facilities. So think of how an overdraft works. So there's no sort of commitment to capital repayments within the facility, and almost operates like interest only. But you don't want to get yourself into a position where you're permanently indebted. But it can alleviate some of the cash flow pressures over a cash flow loan. And also, because of the revolving nature, you just get a bit more flexibility within the facility if you want to sort of manage debt repayments along with sort of working capital. So again, how much can be funded? It very much depends on the quality and liquidity of the underlying assets. You know, the lender will ultimately look at a loan to value position over each of the asset pools that we just spoke around. And the lender also will take a much greater degree of diligence, really understanding those asset values over and above that of a cash flow lender. But ultimately, for a business with a really strong asset borrowing base, it could be possible to borrow a greater amount of money than a straightforward cash flow loan. But the downside is obviously with the underlying assets being used for security, a business has got to maintain that level of assets to keep that level of borrowing. So you wouldn't want to get yourself in a position where you enter at X and suddenly your assets decrease massively for some reason and the lender can no longer have that borrowing base to support its facility. So those are sort of the two broad areas we're looking at when we're funding the transactions and where we've had a lot of success.
Thanks, Jeremy. We've had a question on security, actually. So I know you mentioned, sort of touched upon it, particularly around sort of asset-based lending. The question is around cash flow lending. So what security does the bank have in those scenarios?
Yeah, it's a really good question, and it depends which lender you talk to. So even within banks, high street banks, they could have a different view. But generally, with a cash flow lend, the security is generally by way of debenture. So there's no fixed charge against certain assets. So a lender will have a sort of security blanket over all of the assets. You can move assets in and out of that security blanket with the lender's permission, obviously. But there's no direct fixed charge. Now, some banks, for example, might actually say, to get us comfortable with a cash flow lend, we're almost going to view it like an asset-based lender, and we want to understand that there is good, tangible security. So in those cases, we're often working with probably more specialist debt funds who understand the market a lot better. And we've looked at EOTs in technology businesses, for example, that are very, very asset light. And very much the focus, whilst they've got security under a debenture, very much the focus is, what is the recurring nature of that revenue, that business, and can we guarantee that it's going to keep coming? So, 5-year contracted revenues, good underlying customer base, that sort of thing, over and above just having a strong asset-based business. Ultimately, you'd like to have everything as a lender, but we appreciate, all businesses don't fit a certain model, which is why there's lots of options in the market and why you need to explore them all.
Thanks, Jeremy. I think it's fair to say that not every deal is externally funded. Quite a large proportion of them are funded from cash on the balance sheet, as Jeremy said, and also essentially the owners, the sellers, sitting there and waiting for the cash to be generated by the business to repay them on a longer term basis. And I think that sort of highlights quite an important point for business owners when they're thinking about these sorts of transactions. Is clearly, if you sold your business and you received the entire value in cash day one, the risk of that transaction is over as soon as you've received the cash. In an EOT situation, quite often that deferred element, that element that's going to be paid over a period of time, is going to be at risk because it is subject to the business continuing to perform, generate cash flows, and ultimately repay that loan. And as a result of that risk, that loan should attract a rate of interest, and that again is part of the structure and returns that a business owner faces, because ultimately that there is some uncertainty around that, and that's clearly a key point for business owners to understand. Okay, so I think just moving into sort of looking at the bigger picture when someone sells to an employee ownership, how long does the employee ownership hold that business for? How should people be treating it as they go in? What's the expectation of sort of how it might be changed or reversed in the future? Doug, if you want to take that one.
Sure. So the general idea is that EOTs are set up to hold shares in the trading company or parent company of trading group on a long-term basis. Now, there have been instances of the trustees selling, but EOT companies are not commonly sold. The trustees have a duty to act in the best interests of the beneficiaries, the employees of the company, and the trustees might not consider an onward sale to be in the employee's best interest because of the tax implications. So once the clawback period for the sellers has come to an end, the CGT risk passes to the trustees of the EOT. I mentioned earlier that the trust inherits the seller's original base cost. So if the trust sold the company, then after deducting any remaining deferred consideration due to the sellers and the CGT liability of the trust itself, the balance could then be paid to the employees. However, pay-as-you-earn and NIC would be due on those payments. So what the employees end up with could actually be quite a modest sum on a per employee basis. So the offer would need to be exceptional for it to be in the best interest of the employees. So for that reason, we don't typically see EOT companies being sold once the original shareholders have sold to the trust. So do go into it on the basis that it will be a long-term succession plan.
Thanks, Doug. There's a couple of questions that sort of followed on from the funding side. So just the first one on there is a question around the sort of deferred income or the loan note. So the amount of income that's received or the proceeds that are received over time. Is the interest that's received on that tax-free? Nicola, if you want to.
No, the interest isn't tax-free. No, that's subject to income tax in the same way as other interest is. Yeah, so it's only the capital element, the principal element, which is tax-free.
Brilliant, thanks again. And this one's for you, Jeremy. From for an asset-based lender to a service business, will they lend on debtors, deferred income, and if so, what proportions?
Yeah, so sort of on an asset-based lend, so the lender is looking to basically gear up against the balance sheet assets. So, I mean, very broad brush, depending on sector, etc. There's lots of caveats. Against debtor books, you can go up to sort of 90% of the debtor book. Plant and machinery, again, typically sort of 70-80%. Inventory can be a bit more difficult because it's the expertise of the business selling it. So we sometimes you can see that watered down quite a lot, maybe less than 50. And property is clearly a very good asset to hold. You can go to sort of 75-80%. So the lender will very much look through to each asset class on what they can lend. In regards sort of the deferred consideration and where a lender sits, I mean, both an ABL lender and a sort of cash flow term debt lender, they recognise the deferred consideration debt, but they will want to what we call rank ahead of it. So within a security structure, everyone will understand that the lender is effectively going to get their money back in a loss in the first position in a loss situation. Some funders, may say they want to be out completely before any deferred consideration is paid. Some lenders, ABL, for example, might sort of say, look, we're happy for elements of deferred to be paid alongside our facility as long as there's headroom within the cash flow. No lender's going to let cash flow become stretched in detriment to making debt repayments, and because they're leading the way in the debt repayment, they'll always get the say on what can and can't be paid.
Thanks, Jeremy. We've had a question around a scenario of selling not 100% to an EOT, actually selling 51%. So before we answer that question, I think if Nicola, you could cover the area sort of, does someone need to sell all of their business? How might these be structured if it isn't 100%?
Yeah, the short answer to that is no, that you don't need to sell all of the business, so not 100%. The trust has to acquire a controlling interest, so that's at least 51%. So it's possible to, in theory, retain up to 49% of the company. We usually find that the sellers will sell 100%. That's because if you retain a minority interest, it may be that there'd be no opportunity to realise that in the future, or little opportunity. So as Doug was saying, it should be entered into on a long-term basis. So you don't know whether or not a third party might come along and buy those shares in the future, and it would be down to a decision for the trust as to whether or not the company was sold. Also, any subsequent sale of that shareholding wouldn't be subject to the CGT relief either, so that would be subject to the usual rates. And finally, if you did sell just the minority interest, so the trust kept its interest and you just sold the minority interest to, say, the trust, then there would be a minority interest discount which applied to the value of your shares, which means that you wouldn't necessarily realise a value that you might expect to. So usually, although you can in theory retain the shareholding, often we see that it's actually the sellers decide it's in the best interest to sell 100%.
Thanks. Okay, I think it's probably fair to say that those minority discounts can be significant. For a small minority, you may be talking sort of 60-80%, that sort of level. So that is obviously going to have a big impact. Now, in terms of the question we've had here, I don't know, Nicola, if this is one that you may be able to think about. It's talking about a situation where a business has sold 51% to the EOT, 49% held externally. If those shareholders that hold that 49% are employees too, how does that work when it comes to sort of the the ratio of shareholders to employees that you need?
Okay, yes, so the limited participation fraction, so you can't have more than 40% of the participators who effectively own or can benefit. So yes, the short answer is that they can be included. So those participators and shareholders who are included in that ratio, those who hold 5% or more broadly. So yeah, depending on that makeup of the 49%, anyone who holds 5% or more would be a participator for the purposes of that test.
Thanks, Nicola. Okay, so quite often we're asked the question, how does an employee ownership trust compare to a management buyout? I think fundamentally it is a very different type of transaction, and the core to it really is the management team and their incentive and their equity ownership going forward. So the key differential is under a management buyout, typically you're going to set up a new company, a new holding company that is owned by the management team, and they will hold a personal equity stake, and therefore they are incentivized to grow the value of the business that grows their personal value of the shares they hold. And in employee ownership trust, that's not the case. So that the EOT holds it for the benefit of all employees, and therefore the differentiation is how management might be incentivized under one structure or another, which we're going to touch upon a little bit further. In terms of sort of the difference from a funding perspective, Jeremy, how do funders look at sort of an EOT proposition versus an MBO management buyout proposition, and how do they sort of assess them?
Yeah, I mean, you've touched on some of the points, Matt, but it is really important when you're sort of thinking for external debt funding to have a think about these sort of issues. A key bit, as you've touched on, is sort of that direct lack of management ownership within an EOT versus an MBO, because within an EOT you could potentially have quite a broad ownership, sort of employee ownership structure, which effectively dilutes accountability for the business, whereas an MBO you could have sort of a smaller team who could potentially have personal financial stake within the business, so that their eye is going to be a lot closer to the detail. So a lender would really need to understand that sort of ownership piece, and who's the real driving forces, is everyone aligned. Again, I mean, that comes down to sort of almost like the cultural and operational risks as well within a business, ensuring that all employees understand new roles in the business, because they are indirect owners of the business, and that we're all pointing to common goals. Another area we see sometimes lenders getting a bit nervous is on profit retention. So clearly the EOTs, a lot of the profits are distributed to all of the employees, whereas MBOs, management teams might be more keen to reinvest profits back into the business to grow, future profits and ultimately make debt service stronger. So they'll definitely be focused on that. And then I think as well, just general governance, by having sort of wide body of employees, lenders can get a little bit nervous about, who's really in charge of the decision making here, and who's making sort of the commercial decisions and judgments. Is it a board of 20, 30 people, or are there sort of 3 or 5 key individuals? So all of those things need to be thought about, and you very much need to get a lender comfortable with that sort of versus a typical MBO structure, which ultimately is more like a traditional business structure.
Brilliant. Thanks, Jeremy. So I think, I guess moving on to, I think one of the things that is sort of coming through here is sort of alignment and bringing people through the journey, because it is quite a change from business as usual in terms of the governance and the structure. Nicola, how should people approach employee engagement, employee communication?
Yeah, it's really important, as you say, to make sure that you're bringing the team along on this journey and that they're comfortable with it, and particularly for the key management team. So if they're not brought in, then the whole transition itself is likely to be in jeopardy. So you really need to build into your kind of project plan about how you're going to communicate with the management team and employees. Yeah, we usually nearly always recommend that it's something which is discussed at an early stage with the key management team to ensure that they are on board with it and understand what it means for them. So that would usually be something which is part of the sort of the feasibility in terms of, is this the right succession plan for the business, involving some of those key management will be really important. But then there's also the wider workforce as well, who may not need to be involved in those early discussions, but will usually need to be told about what it means for them and what the transition means. And so that can be some communications pre-completion and maybe post-completion as well. And advisors can help with that, those sorts of question and answer sessions or question and answer documents as well, to help with that process.
Thanks, Eka. I think we've all in our team heard the sort of war stories of where a shareholder has sold their business to an EOT and the day after announced it to everyone who knew nothing, and that's clearly not the way to do it. So
no,
bringing people through the journey is fundamental. So we've talked a little bit about how the dynamics of management and how important they are to run the business if you've got a scenario where a shareholder is selling their business to EOT and they are exiting. So Doug, perhaps you could talk a little bit around how someone might incentivize that management. If they were considering an MBO where they've got shares, they may not have that opportunity now. So what sort of incentivization for management might people consider?
Sure. So another key feature of EOTs is that once the EOT has acquired a controlling interest in the company, bonuses of up to £3,600 can be paid to each employee each tax year, tax-free, but not NIC-free. And one of the conditions for tax-free bonuses is that, broadly speaking, all employees must be eligible to participate. The amount of the bonus can vary between employees based on hours worked, length of service, and salary. So that's good. That's a good amount, but it might not do what you want to do in terms of incentivizing management. So alongside the tax-free bonus scheme, you could have also a conventional performance-related bonus scheme, for example, just for managers. So not tax efficient, but potentially highly incentivizing. One question we're often asked is whether it's possible for an EOT company to have a share option plan, and the answer to this is yes. However, share option schemes tend to work best where there's a good chance of the company being sold, because this means that the employees have the potential to sell their shares at some point and realize a gain. This could, in theory, still happen with an EOT, but as I mentioned earlier, EOT companies are rarely sold. One thing that could be put in place is possible to create a second trust, an employee benefit trust, or EBT, to act as a warehouse for the shares and create an internal market for them. So the way this could work is the EBT has the power to buy shares from employees who've acquired them through an option, and potentially employees can trade shares between themselves as well using the EBT. So although this could solve the problem of the employees being able to sell their shares, an important point is that the minority interest discount that we touched on earlier, that would need to be applied to the sale price. So that the employees would need to expect a payment for their shares, which, although based on the whole company value, is then heavily discounted for the fact that they're only selling a minority shareholding. All of this doesn't mean that an option plan can't work for an EOT company, and we do see management share schemes set up, including tax advantage schemes like EMI, just in case there's a sale in the future. There are just some more things to consider than you'll typically have with a traditional exit day share plan.
Thanks, Doug. So I think looking at it from a business owner's perspective, clearly if they sell their business to a third party, that might be their sort of ticket out of the door and ticket to retirement. Now, from a sort of employee ownership trust perspective, perhaps there's a situation where the management team isn't quite ready to take complete control of the business, or scenarios where there's somewhere in between. I guess, Nicola, what role can a seller play in the business going forward?
Yeah, they will usually want to stay and have some involvement for a period of time for two main reasons. One is to help with that succession, so to help with the management, the new management team to take on the business. So they'll usually want to make sure that there is that sort of smooth succession plan, and also they will nearly always have a number of years over which they are owed money from the company, which depends on the success of the company too, and so they'll have some interest there as well, to protect that position. They can have an ongoing role, but there are a couple of key things to think about. So one is that they can't control the trust. So as Doug mentioned, usually the trustee will be a corporate. So it's key to work out who the directors of that trust company are going to be, and it's really important that the sellers don't control the board of that trust, so they don't control the trust. In terms of the company itself, there's no sort of specific rule which says that the sellers can't continue to control the board of the company, but HMRC don't really like that, and there are certain anti-avoidance provisions which could in theory apply if they retain control of the board of the company. So again, we usually recommend that they might want a role on the company board still, but shouldn't control that either. Finally, it's worth making a point that often they want some contractual protections as well to help protect this amount of money that they're owed over a number of years, and so there'd be often certain reserved matters which the company and the trust can't do without their consent, like for example sell the company. So usually there'll be some discussion about what those reserve matters, and just a bit of care needs to be taken that they don't go so far as to mean that the sellers retain effective control of the trust as a result of those.
Thanks, Nicola. We've had a question which I think is following Doug's discussion around EMI schemes. So if a company has an EMI scheme in place which is triggered upon an exit, and that exit is the company being sold to an EOT, do all of those with EMI options have to wait for some deferred consideration? So that is, I guess, if the consideration is going to be paid part in cash, part in deferred, how does that work from a cash flow perspective for those EMI shareholders?
So first of all, the EMI shareholders would be able to exercise their options to sell them to the EOT alongside the other shareholders and get the tax, the CGT tax tax relief. In terms of the deferred consideration, you could potentially structure the sale consideration so that it's different consideration profile for different sellers. So potentially the EMI option holders could just get cash for their shares.
Okay, thanks, Doug. Right, so I think just sort of moving on to perhaps some of the issues, or perhaps some of the risks. So I mean, some of those bits and pieces we've covered along the way, but I guess fundamentally, what are some of the key risks that we've got in these sorts of transactions, Nicola?
Yeah, so one of the key risks is the tax. So if the qualifying conditions aren't met, then the 0% will not apply, and the gain would be subject to capital gains tax in the usual way. So that could be quite a chunky percentage of the proceeds. So there is that risk, and there's the risk not only just that the qualifying conditions aren't met perhaps at completion, but also over a number of years if there is a disqualifying event, which broadly means that the conditions that were in place at completion are no longer true, that relief can be clawed back. Or if it's after the 4 years after the end of the tax year, the trust could be subject to the CGT charge instead. So those are quite quite big tax risks. So it's really important to make sure the qualifying conditions are met, and also that this is monitored over the course of the life of the ownership structure as well. There's also various other tax risks. So we've mentioned before that it's really important that the trust doesn't pay more than market value. That's not just to get the CGT relief, but also anything in excess of market value is likely to be subject to PAYE income with very high tax rates. So yeah, that's another risk. And also there's an exemption for the trust for the tax on the contributions which the company make to the trust to pay the deferred consideration at the profits, but that there are various conditions which attach to that exemption, and so that also needs to be something which is carefully considered and monitored.
Thanks, Nicola. I think just sort of adding to that, we have spoken about the sort of management team and the succession of the management team, and clearly, a quality management team to run the business going forward, to make a success of it, is fundamental, both to the business itself, but also the success of an EOT. And certainly if the team aren't on board with it, or they're not engaged, that's a big red flag and a big risk to the success of the deal. So the other area I think is on the funding side. Now, clearly, I've mentioned from a shareholder's perspective, there may be a period of time that they need to wait for that, but from a business's perspective, there may be a scenario where a business had no external debt. It's going into an environment where it does have debt on the balance sheet, and it does have debt obligations, and it does need to answer to a third-party bank. And clearly, if it doesn't meet those obligations, there's risk there. So that also is something that is fundamental when looking at these transactions, because it needs to be affordable. The projections and the modelling need to stack up so that both the bank and the vendor can be repaid over a sensible period of time. So I think we've got no more questions unless any final ones come through. So I think I'd just like to sort of wrap up on some of those key points that we've touched upon throughout, really. So hopefully what's come across today is that it is very different to other types of transaction that you might entail. It can be quite complex, particularly on the tax side. And I think certainly from sort of the governance of these sorts of transactions relative to a trade sale or a management buyout, it is very different and and that needs to be managed carefully. And I think if anyone is considering doing one of these transactions, I'd highly recommend a good corporate lawyer that's got experience of EOTs, not just corporate transactions, because their support is going to be fundamental in its success. Hopefully there's a few areas that we've touched upon around when EOTs are suitable or not suitable. They are not suitable for everyone, and certainly those that are looking at purely from a taxation perspective, that may not be right for them. And I think probably mentioned quite a few times, bringing management on the journey, bringing the team through, because ultimately the future success of the business is linked to the future success of the transaction. So I think just sort of finally, I'd like to say thank you to Jeremy, Doug, and Nicola for their contributions today. Please do feel free to reach out to us if you want to discuss anything that we've covered today, or your own circumstances. And thank you for listening.